Well, hey there, everyone, and welcome to the VIP Trade Room with Roger Scott and Matt Horton. Today is Friday, February 20th, and my name is Raleigh White, and I'm coming to you live from a overcast day here in Austin, Texas, and I'm going to be your moderator today. Now, in today's session, Roger is going to be covering a range of important topics with a special focus on gaps and how to trade them. Now, he's going to start things off by giving us a midday market analysis and an update on what large cap stocks is currently on his watch list. And then we're going to pivot. Roger's going to talk about what is a gap and what percentage of gaps actually get filled. He's then going to talk about how long it typically takes for a gap to get filled and what volume is needed for a gap fill or for a gap continuation. Once again, the impact and the role that volume plays on that. He's then going to talk about why now is an all new season on trading gaps with high accuracy. And as a special bonus, he's going to share with us how we can develop an edge that we can use for the rest of our trading lives. So, an exciting session today. I know Roger's jacked up about this, and the focus is going to be on gaps. Now, if you've got any questions during Roger's presentation, please type them in the chat window and we'll address them periodically throughout the session so as to not interfere with Roger's presentation. And folks, remember that the chat is open to everyone, and please remember that we have some ground rules. Always be kind and supportive in your posts. Number two, please keep to the topic. Number three, no political discussions allowed whatsoever. And also, folks, please keep those side one-to-one conversations to a minimum. All it does is interfere with the rest of us that are trying to listen and learn on the education that Roger's sharing with us, because after all, he is here to give us an edge in the markets and to help us all become much more confident and consistent in our trading activities. Now, for those of you that were with us this morning at 8 o'clock for Roger's pre-market briefing, you'll note that there were several catalysts on tap that we needed to be aware of today. On the tech front, we saw that Alchemy Technologies was down 10% coming into the open. On the business front, we noted that Plovin and Copart were also, Plovin was up 6% coming in, but Copart was down 7% coming into the open. On the health front, we saw that Molina was down 2% coming into the open. And on utilities, PPL Corp was getting ready to release their earnings before market open. On the international front, we noted that the DK was down 1.2%, so we weren't getting much headwinds or tailwinds, if you will, from the international side. And also remember, folks, that this week that the Shanghai markets have been closed for the lunar holidays. Now, on the Fed front, a lot of activity, okay? We noted that the Supreme Court was going to open their session today, and the question was, were they going to release any information on their rulings for tariffs? And boy, did they. We also noted that we had GDP data coming out, and it was disappointingly lower than expected, and that was followed by personal income. We had the flash PMI reports, new home sales data, consumer sentiment, and we also have two speakers scheduled from the FOMC. So an awful lot of activity to be aware of on the Fed front. Now, when it comes to catalysts, folks, a lot of people have asked me, Riley, why do we even talk about these? Why is this so important? Well, from Roger's perspective, you know that he wants us to all understand holistically what's going on in the markets before we drill down and make decisions as to what we want to trade. And so from that standpoint, anytime that there's information that is known or will become known during the trading session, but is not yet priced into the markets, those are volatility flashpoints that we need to be aware of. So from that perspective, it's important that we understand what's going on, and for those reasons, we list these catalysts. Now, as far as Roger's large cap pre-market stock watch list is concerned, you'll note that he had 6 short stocks and 12 long stocks. Now, on the short side, once again, Roger shared with us why he's so picky here, because there are a number of stocks on the short list, but many of them are just, doing deep falling knife dives, and he doesn't enjoy those whatsoever. He likes to look at stocks that have been on a gradual decline. And from that perspective, these were the six that are on his watch list, and some of them we have seen here for the past several days. On the long watch list, we had 12 tickers that he was looking at, and you see them listed here. So to be clear, when Roger wakes up in the morning, one of the first things he does is scans the market for stocks that he might want to trade either to the short side or to the long side. Now, these are why it's on his watch list, but these are not recommendations. Hey, go invest in these stocks. No, Roger says they're on my watch list. And when he brings them up in the morning session, he usually gives a very quick synopsis as to what he sees, what he expects, and what he would like to see in order to consider taking a trade on these stocks. And when that happens, folks, typically he'll release that in his trading pit or in one of the other premium alert services that he has. As far as his pre-market thoughts are concerned, the futures markets were all kind of up, we're all moving sort of randomly lower into the market. And from that perspective, as news started to come out, in particularly GDP data, et cetera, like they were sort of accelerating to the downside. As far as the put to call ratio was concerned, is it unbalanced to the put side. As a matter of fact, it's at a level that Roger says he has not seen over the past 3 years. He's only seen it happen about a dozen times at that level. So he says puts have been ruling today, but they're starting to get a bit expended. And when it gets here, he expects things to start to fall back more as calls start to take over. But coming into the open, the put call ratio was extremely unbalanced. He also noted that the VIX was higher and it was still trading at that 20 level. It's kind of stuck there, and he's hoping that it doesn't go up to the 23 level, hopes that it comes back a little bit, but that's where the VIX was pre-market. Now, as far as momentum is concerned, we did note that the number of companies making 20 and 90-day highs was significantly outpacing those that were making 20 and 90-day lows. So once again, the momentum there to the upside, very, very little momentum to the downside. As far as sector rotation is concerned, we noted that things were continue to favor defensive stocks. We saw that energy and utilities and real estate, things of that nature, were occupying the top spots in the sectors. And so from that standpoint, Roger says we're not going to be getting much support from those speculative stocks that typically are market movers. As far as the bonds are concerned, the bonds were still up and they were moving sideways. And once again, that initial burst up in bonds was an absolute flight to quality. I mean, it's a defensive move, and bonds were still hanging around at that level. He noted that the SPY and the QQQ and the MAGs were also trading flat, very, very choppy, stuck between support and resistance. And his point was, look, guys, this is a really, really tough market to trade right now. We all should be cautious. His biggest concern is choppiness, and it's not giving us any real decent opportunities for swing trades. Quick trades, scalps, day trades, but basically, that's what the focus is. But it's a very dangerous environment for swing trades. And he says, and folks, it is Friday. It is Friday, and Friday in the afternoon, things are going to tend to quiet down a bit. So once again, Roger's basically saying, unless something happens, we're basically stuck here. And guess what? Something did happen. The Supreme Court of the United States basically established that the tariffs that were implemented were not constitutional. And that's throwing a whole lot of stuff on the markets at this point in time and was a huge catalyst for movement that I know Roger is going to be talking about. So we're delighted to have you here today. As always, we have a tremendous group of people here. Roger's community is fantastic. We are a family. We support each other as we all look to become, more proficient at this business that we call trading. And Roger has put together yet another terrific agenda for us today. And he's excited about this. He hasn't done this in a long time, and that is to give us a masterclass session on gaps and how to trade them. He's going to start by giving us the midday market analysis, which will be extremely important today, and his updated watch list. And then he's basically going to talk about, well, what is this doing here? That's the wrong one. I'm sorry, for February 20th. He's then going to basically talk about what is a gap, and what percentage of gaps get filled. All right. Then he's going to talk about, how long does it typically take for a gap to get filled and the importance of volume. In other words, when is volume needed for the gap fill, or when does it suggest a gap continuation? He's also going to share why we're in an all new season for trading gaps with high accuracy. And as a bonus, guys, and this is great, he's going to teach us all an edge that we're going to be able to use for the rest of our trading lives. And if you've got any questions during Roger's presentation, please type them in the chat window and we'll address them periodically throughout the session so as to not interfere with Roger's presentation. And remember, folks, that the chat is open to everyone, and we do have some ground rules. Always be kind and supportive in your posting. Number two, please keep to the topic. Number three, no political discussions allowed whatsoever. Also, keep your side conversations between one or two of you to a bare minimum. This is not a general chat room, guys. We are here, all of us are here, to learn from the information and education that Roger's sharing, because he's here to give us an edge and to help us become much more confident and consistent in our trading activities. And with that, let's say hi to the team. And boy, do we have a team today. We've got Matt, he's at the controls there. We've got Roger, who has just been, I think his head's probably been spinning with everything going on this morning. And we've got Kane joining us from the West Coast. So, folks, we have you covered today. Roger, I loved your closing comments, which was be cautious, things are sideways. You don't see anything happening unless something happens.
Right.
Something's
Exactly.
got to happen for things to move. And I
Exactly.
believe maybe the SCOTUS ruling was that catalyst, at least at this point in time. That's my opinion, but that doesn't count. Yours is the opinion that matters.
The truth is, from what I understand, Trump is gonna have a conference at 12:45.
Yeah.
I just found that out a minute ago. So that is going to obviously, and we all know exactly what he's going to do. He's going to again double down, no, quadruple down, and he's gonna continue saying how we're going to figure out another way around it. And I'm not going to listen to any of it. I'm just going to look at what the market does. To be honest with you, I can't even keep track of the move pro against. All I know is that this morning, I warned everybody that this was going to happen right before the announcement. What happened to the market? What happened to retail?
Mm-hmm.
Shot up, and I got so many emails saying you said we were going to go. Retail was going to go up. And because that's what happened last time. I was watching the market last time. We were about to come with the announcement, and they said no announcement, and they just dropped. So obviously, retailers do not like these tariffs. I mean, it makes sense. So the same thing happened today. They went up, but now the market looks like it's just consolidating. My big concern, I'm just going to share my screen real quick, is my main concern right now is this, not the tariffs. My main concern is getting the SPY above the 50-day moving average and having it stay there.
Mm-hmm.
To me, that's a lot more important than tariffs, okay? Because institutions love to come in when we're above the 50-day moving average, and they don't like to come in when we're below the 50-day moving average. So us closing up here would give institutions a lot more confidence in this market right now. Unfortunately, we have another thing, which is Iran right now. I got to say, we have, when I said that we're going to have no shortage of news this year, I guess even I underestimated it, right?
I know, Roger, you can never tell. Yep.
You never could tell. So I really want to see this, and you could see we're getting close. I mean, we're what, at 687.55 and 680. We're literally right here right now. So we're on the edge.
We've kissed it about 3 times today.
Or
we've
I was
come
about
right
to
up to it. I like the way you said we huffed and we puffed and
yeah, we huffed and we puffed and here we are. Now we did get out of a couple of trades today. We made some money. We made money. Finally, we're out of that Micron trade we've had for a week. I'm glad to be out of it. Made a little money on that. We had a straddle on a miniature MSTR, which we took a little bit of a profit on today as well. And now we put on a position in a non-tech stock because I want to be a little grounded, because I don't know how these positions will turn out today. I mean, I don't know what Trump will say. if I had to put money on it, and folks, I'm not going to get into this whole what's going to I don't know what's going to happen. I have no idea. But I know that the Supreme Court was actually very reasonable. And they did not rule everything. They didn't throw the baby out of the bathwater. They still left a lot of the tariffs on things relating to fentanyl, things relating to aluminum and metal. Those are things where we have an issue with other countries. So they really gave Trump, in my opinion, a lot of leeway. Okay. Another major thing, and this is something T-Buzz and I were talking about 2 days ago. We went out to dinner. I said we both predicted that they were going to be loosey-goosey on the giving the money back. And we both predicted they were going to kind of give them a lot of time, but they didn't even talk about it. They didn't even mention it. So
no, I don't think that's an issue in the Constitution. That's going to be a practical matter for the impact. And once again, Roger, I mean,
yeah,
the
but
airways are being flooded with everything.
Yeah,
They're being
yeah,
flooded with everything.
right. I don't, and folks, unfortunately, I don't have answers for you. But I will tell you this: I made two predictions a year ago. That one of the predictions was Elon Musk was going to get the hell out of Dodge,
Yeah.
and the second prediction was that this was going to get overruled by the Supreme Court. I made those predictions right around the time that our president took office. I've been very consistent with both of those decisions the entire time, as you know, the entire time. And as you could see, one second, I got to tell them to get out of Oracle with a profit. 1 second. Take profit on Oracle scale and send me a nice note. All right, there you go. All you Oracle scalpees. Did anybody make money on Oracle scalp in the pit? Let me know. Let me know. All right, so I did make those two predictions, and I stuck with those two predictions. And guess what? Elon Musk is not got out of Dodge, and the tariffs. It's going to be very, very difficult for our president to negotiate right now with other countries. He's not going to be able to use if you don't do this, I'm going to increase your tariff. Those days are gone. That's done. But that's as far as I know. I don't know what the administration has up their sleeve. And my question is, if you have something up your sleeve, why not just do it the right way? In my opinion, this is called shooting first and asking questions later. And that's not really the way to do things, because now we have a huge issue of money, and we have a huge issue of other countries basically saying tariffs. What tariffs? Tariffs? Did you say tariffs? We didn't see any tariffs. So it creates a big, big problem. But fortunately, that's not what we are here today. We are here right now to dissect what's happening in the market right now. That's already in the market. And by the way, that is a beautiful short right there. It's an A-line to the downside on Oracle. That's the first stock on my list, actually. Okay,
Mm-hmm.
I have a huge.
And by the way, a number of people have chimed in saying they did well with Oracle today.
Oh, good. I'm so happy to hear that. Nice, nice, nice. People love those scalps that I've been giving them in the pit. They've been very happy with those scalps.
Well, in this environment, as you've been pointing out, Roger, in this sideways motion where swing trades are just difficult to find, those day trades and those scalps would work out.
And for the record, we still haven't had an official loser in the pit since October 13th. That's over 55 trades now.
I'm just saying.
Just saying. All right. So the market, as I mentioned, we're right at the literally, we're right at the 50-day line. I would feel much better. I would feel like 10 times better if we close right here at the upper part and not here, because that would trigger a lot of algos, and I think that would trigger a lot of buying programs if we close above. And I kept telling you guys 688 level, the 688 level. There's a lot of stuff there. Actually, you could see it right here. It's actually right here. It's actually right here, 689.13. We got to get above this level. And it looks like we tried 3 times already. So we really need to get above this level and get somewhere here. This is actually already above the 50, but that's just kind of where we need to be. Mega caps. This is very nice. This is very nice. I like how we keyed. And by the way, Kane, welcome, and I'm glad you're here. Kane, give me a minute. I want to finish this. There'll be more people coming in here, and then you can tell us all about Monday, okay?
Sure, yeah.
Kane has just a little surprise he wants to share with everybody. All right. So mega caps right here. I like how we're holding the 200. This is really nice, and I like how we're trying to break the 50. This is a move in the right direction. As far as QQQ is concerned, we're just kind of consolidating here. We're not really doing anything. SMH is cooking with gas. We're continuing going higher, and actually looking really, really nice. So overall, if we can get the mags to move right here, we'd be in a much better position, in my opinion. Okay, we'll be in a much, much better position, in my opinion. And by the way, I have a class for you guys in a few minutes, and I think this class will knock your socks off. I'm doing it as a special bonus for you guys today because we have a bigger room than usual today for the room. I have very special stuff to tell you. So, and now we have the tariff decision. It's going to be a very, very interesting Friday. So, folks, this is going to be, you're going to learn a lot right now. Okay. It's going to be a fire hose moment in a few minutes. Okay. When I say fire hose moment, I really mean fire hose moment. I'm going to ask you if it's a fire hose moment when we're done, and I'll see what you guys have to say. Okay. All right. All right. So, my suggestion is to keep your eye on the mega caps. Okay. And my suggestion is to keep your eye on the SPY and the relationship between the SPY and the 50-day moving average, which right now we're falling. And again, Trump is going to be speaking. Hey, Richie, Trump is going to be speaking in about half an hour, and we know exactly what he's going to say. Not to worry. We got it all figured out. Everything's going to be okay. And Plan B. Yes, Plan B. Exactly. Plan B. Whatever Plan B is. I have no idea what Plan B is. But I will tell you this, if it's cute, if it's something that's cute, it's not going to go, investors are not going to be very behind it. And more likely than not, it's going to be cute. Otherwise, he would have done it the first time. Kane, why don't you give us your 5 cents about the whole thing? Just, I don't want to put you on the spot. Just whatever you want to say about it. If you want to say anything about it.
Yeah, well, obviously it's a focus in the market, so it is a major catalyst. And volatility is all I could say. Is you've seen the major volatility at the announcement. Hasn't let up since then, and once the president opens his mouth, you're just going to see a whole lot more of it. So be careful. I warn people in my Telegram channel. If you think you have an edge, it can be taken away in an instant or in a tweet. And if you're trying to get out of a trade that's going against you, well, just at the very least, wait until that volatility collapses, because that volatility is really working against you. So the only place where it really helps you is if you want to take profits and you're not hurt by a wide bid-ask spread. It's hard to hear me.
Seconds.
Okay, maybe that's better.
Yeah.
Yeah.
Okay.
That was good, Kane. Yep.
Okay, good. Yeah. So yeah, basically don't get too excited. Obviously the market is super excited, but that's when we want to be calm and rational and actually look and make sure we actually have an edge.
Good. Good. Now, you wanted to tell us something about Monday.
Yes.
Please share with us this.
Well, especially after the announcement today with the Supreme Court, and I think this is going to be a perfect timing on your part, by the way, for the gap class, because we're probably going to see some gaps here because of all of this. But on Monday, Roger and I are getting together. We've got something really, really cool for you guys. It is something that I've been working on for many years. It's something that I've used to create edges while I was on Wall Street. And you have heard me talk about the concept before, but the way that we're implementing it now is really, really cool. So you don't want to miss out on it. I know I'm not giving you very many details, but it's because we're going to reveal it on Monday, and it's going to be super exciting. And with the volatility that's coming into the markets, it should create a lot of opportunities for us as well. So we got a link for you guys. And do you have it, Raleigh, or I think I have it? I've got it. I can drop the link for you guys. Make sure you register for it so you can join us live on Monday. And I would do it now because you're going to get excited about the gap class. You're going to forget about it. And then Monday will roll around. You're like, oh, shoot, I forgot to register for this thing. So I would do it now.
All right, perfect. Perfect. It's going to be very it's going to be great. I'm looking forward to it, and I think you guys are going to absolutely be in love with it. All right, so I want to talk a little bit about I want to talk about gaps, and I really hope you guys pay attention because this class is going to be something that you're not going to learn on your own, and I really hope you guys pay attention. I really hope you guys pay attention, and also please sign up to for Kane's project. I'm going to post this right now, Kane, on my Telegram channels. Okay,
No, thank you.
real quick. Yeah, let me just post this on all my Telegram channels while I'm here. Here, don't miss this on Monday. Okay. All right. And let me post it somewhere else. All right. It's all there. It's all there for you guys.
Yep, and I see a bunch of people are already signing up. That's great, guys.
Okay. All right. All right. All right. All right. So where do I start? I want to explain this to you guys, and I really want you guys to understand this. And I'm gonna go a little deep here, but I'm gonna start off back. Okay. Whatever you guys are doing right now, I'm gonna make a little promise to you. What I'm gonna share with you is more important than whatever you're doing right now. Whatever it is you're doing, whether you're a day trader, whether you're a swing trader, whatever it is that you're doing, whatever you think you're doing, whatever you think is more important than this, it's not. Okay, it's not. And I'm going to ask you that question when I'm done, and I'm going to see how many people say, Roger, you're absolutely right. This was pretty important compared to whatever I was doing. So please stop whatever you're doing and listen to what I'm going to tell you. Okay. Okay. Not going to charge you anything. I'm just going to teach you something right now. Okay. So a long time ago, I explained to you guys that when you have to look at the market very differently than how you're usually used to looking at the market when it comes to pullbacks. Okay. What are gaps? They're pullbacks, right? That's what they are. Either pullbacks. We're only talking about gaps that are going against the trend, not gaps going in the direction of the trend. Although they could theoretically be going in that direction, but we're talking about pullbacks. So, and I explained to you guys that a lot of times what you guys do is you wait for a very deep pullback. In other words, a stock is trading at stock is here. Let me give you an example. Good example. There's so much good information to share with you here. I wanted to find a good place to start grabbing your attention. I think this is a good place to start grabbing your attention. Okay, so let's look at IBM. I know this because this bit me in the butt last quarter because I forgot to liquidate my positions. Where was it? I think it was, let's see, back, go 6 months back. I think it was this gap right here. Okay. Or this gap right here. It doesn't really matter. But what I explained to you was this. I explained to you that a lot of you are trading pullbacks completely wrong. And I explained to you, that what most of you think is, oh, the bigger the pullback, the better. Um, the price will come the price will come back up because it's a deep pullback. In other words, if a stock was at $320 and now it's at $250, it pulled back. And that's a better price because the cheaper the price I paid, the better, right? Well, and I explained to folks uh, that, and I really, really explained this to folks that that's not how it works in the real world. And the analogy that I gave you, and I really hope this makes sense, and the analogy that I gave you was very, very simple. Very, very simple. That if you touch somebody or if you cut somebody with a little paper cut, that paper cut is much easier to recover from than if somebody cut your arm off, right? You guys get that, right? It's a simple concept. And I'm being extreme. But think about this. If somebody hits your car at 5 miles per hour, a fender bender, easy to fix, right? But if somebody slams your car hard, well, it may be totaled, right? Right? So that's a problem. That's a problem, okay? That's a big, 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 big problem. So the way you naturally think, Jen is asking a good question. How much is too much? We're going to get into that, Jen, in a few minutes. But I went as far as I knew this happened because I would see it over and over and over and over and over and over and over again. And finally, I made an indicator called the quantum indicator. And I'm not going to sell you the quantum indicator, but basically what the quantum indicator does, it's based on, it's very similar. And I showed you this before. We had this session about a week ago. And I showed you the RSI oscillator, okay? And I explained that if you put this on 14, which is the standard setting, you're gonna have to, I mean, it'll become oversold when the stock literally falls from a cliff. I mean, the stock had to drop 70 points for this thing to become oversold. I mean, look, this thing right here, the stock went from 322 to 296, and we are still not overextended to the downside. Okay? So my point is the RSI doesn't work really well because it tries to find very deep pullbacks, and deep pullbacks don't work well, as I explained. So, but if you take this indicator, and I've explained all this before, right now I'm not teaching anything new to you. I'm just trying to give you some context. So if you go right here, you'll see that if you go to the 2-day RSI, this stupid indicator becomes actually really smart, right? It becomes really, really smart. Because now you could baby pullbacks, little pullbacks. It finds little pullbacks, and little pullbacks get filled. Okay, they get filled. All right. So, 1 second. All right. All right. The moral of the story was, this was about 2 years ago. So everything that I'm telling you right now, I explained to you 2 years ago, and I sold an indicator that does a better job than the 2-day RSI. Okay. Again, I'm just trying to put it all together for you. And the basis was, and I back tested it, and it worked really, really well. Now you're probably thinking, Roger, what the hell does that have to do with anything we're here for? Well, what I back tested and what I explained to you was that gaps or moves that happen deep, they usually are not that great and they don't recover that fast. But little moves recover really well, really well. So that was a couple of years ago, and I kind of stuck with it. But then I got to thinking to myself, and I started thinking, and I realized, I said, why don't I do a back test? Why don't I do a back test and actually go through this with you? Okay. All right. And prove this to you. and maybe even add a couple of interesting things to you in here. So what I did was I did a test going back from 2021 to 2024. I tested 65,500 gaps. You think that's a good enough number for us, Raleigh, to work with?
I think that's a great statistical average.
And we used 99 stocks from the S&P 500.
All right.
Okay. So S&P 500, S&P 500, right? S&P 500, large cap stocks, 65,500. Ken, do you think that statistically has some relevance maybe? Possibly. You think it's enough? Ken says super sample size. Ken is a post-PhD in math from MIT. If he says it's a good enough sample size, it's a good enough sample size for me. Don't argue with me about math. Argue with him. If you're foolish, but argue with him. Don't argue with me. So now, what is a gap? What is a gap? A gap is a move against a trend. So if a stock closed at 10 yesterday, and opened at 9 today, that's a 10% gap. Okay? So I want to make sure you guys at least understand what we're talking about. We're not looking at gaps from the low to the open. We're looking at from the closing price to the opening price. So you may not even see it on the screen. You may not even see it if it's not big enough on the screen. Okay? And you may be asking yourself, well, is he talking about the long side or is he talking about the short side? Okay. All right. Well, we'll get to that too. So let me show you some interesting stuff here. Fire hose time. Same day traders, same day. If a gap is from 0.30% to 0.75%, the same day, so this is wrong, sorry, not 77%. This is, hold on. I'll tell you what this is. That's the wrong number. Hold on. Bear with me. Yeah, that's what I thought. Yeah. Okay. 72. Okay. So, same day. Now, this is really important if you're a day trader, okay? No, Dixon, I'm not, because I want you to pay attention. So, if the gap is from 0.30 to 0.75, there's a 72% chance it'll fill. If a gap is from 0.75 to 1.5%, there's a 54% chance it'll fill the same day. If the gap is from 1.5 to 2.5%, there's a 39% chance it'll fill. Do you see how if the bigger the gap, the less odds it'll fill? How it goes down? What if the gap is over 4%? It's a pretty big gap, right? Stock to be down over 4%. 15% filled that day, basically coming back to the closing price of the previous day. Now, how about this? What if, same thing, same metrics, but this is 3 days to fill. Swing traders, this is when you should be listening right now. 87%, 77%, and the 5 day for this is the sweet spot right here, is 82%. So over a course of 3 days, a gap that's less than 1.5% fills 77% of the time. It's only 65,000 examples, so, not too many. And 82% over 5 days. Now, here's where things get interesting, okay? Notice that as the number gets lower, so what do I always tell you? Big gaps tend to continue, not come back. But that wasn't the best part of the survey. Do you guys want me to tell you the best part of the survey was? Not survey, the back test. Okay, now, was that interesting? Did you find that interesting? Did you find this interesting? Okay, right? So the bigger the gap, oh, I haven't even got to the good part yet. Now, how does volume play into all of this? Volume. How does volume play into this? So what we used was, see how this is the volume 50-day? We used the 20-day, okay? So we used this. So same thing, basically. Same thing, but 20-day average volume right here. This is what we used. Now, this is where you want to, volume plays a lot. It always comes back to volume. Of course, everything comes back to volume. Everything comes back to volume. So if the day before the gap, now this is where you want to really do this. This is where I'm getting, you don't know this yet, but I'm giving you about $10,000 worth of information right now. But you just don't know it yet. You will one day, maybe you won't. But I'm giving you about a $10,000 class right now. But you need to listen. You need to listen to me. Because I was puzzled by this. I'm not going to post anything for you. I've already said it. I'm not posting anything. I'm posting it, but not here. I'll tell you at the end where I'm posting it. There's an appropriate place to post this. So now this is where the fun stuff starts. And after I tell you this, I want you to think back on what I've been teaching you all these years. Now Hefe's got it right. Okay. So how does volume play into all of this? Right? How does volume play into all of this? Well, let me tell you something interesting. If the volume is less than average during the gap, less than average, see how it's less than average? Then the odds of the gap filling the gap is 64% for all gaps, all of them. Low volume right before the gap means there's a higher odds the gap will fill. Average volume means it's right here, right here, right here, right there. That's average volume. That's average volume. Average volume, there's a 53% chance the gap will fill. What if the volume was high before the day of the gap? Then the odds are only 29% that the gap will fill. Now, if you've been following me, or if you've ever listened to anything I say, then what you're going to say is, hey, Roger, this completely falls in line with what you've been trying to teach us for the last couple of years. But this is quantifiable. I mean, 65,500 sample size. So what this is telling us is this. If you see a gap and you want to trade a gap fill, you want small gaps on low volume. If the gap has high volume, then the odds are that gap is going to continue moving in the direction. Big gaps on high volume tell us the move is going to continue. Small gaps on small volume tell us the gap is going to revert. So, if hypothetically speaking, let's say I'm looking at a stock like, and this is just pure hypothetical speaking, but let's say that I'm trading a stock like Johnson & Johnson, and the stock gaps 1.5% at the open on low volume. What are my odds that that stock is going to come back up versus Johnson & Johnson gapping down to here on high volume? Small gaps on small volume come right back up. Large gaps on large volume continue. And you could see right here, not the day of the gap volume, the day before the gap. So you don't have to know anything. You don't have to predict it. You'll have it right there for you. So basically, the day of, basically you're looking at it at you're looking at it the day before the gap happened or the day of the gap because you're trading the gap fill, right? So the day the gap occurred, you want to see what the volume was. So how often do you see a stock, your favorite stock, opening down just a hair, about 1%, and and the day before the volume was really, really low? That stock over the next, if that gap was between 0.75 and 1.5%, that same day, the gap has a chance of being filled 72% of the, if it's 0.30 or 0.75, 72% of the time, and 54 on the same day. When you add the low volume to it, that increases it to 64%. So do you guys, now I'm going to, so what is the takeaway? The takeaway is this. If you see a gap like this, or a gap like this, and you see the volume on these days, and you're going to ask me, Roger, what's the odds of the gap filling? Not so good. Capiche? On the other hand, if you have a little gap down like this, and volume is low, the odds are it's going to fill it right away. Okay? And now, some questions that I know that are burning burning a hole right now in your is, well, Roger, what about longs versus shorts? Okay. No change. No difference. No difference. Yes, in a crazy bull market like we've been in those 4 years, over 65,000 samples, the numbers were exactly the same, filling gaps to the short side or filling gap to the downside. Sebastian, I'm answering your question before you even asked me. So we're talking about, if you have a gap up, is it going to come back down? If you have a gap down, is it going to come up, or is it going to continue going? The size of the gap and the volume preceding the gap will give you a very, very good understanding of whether that gap is going to fill or not. Who knew, Scotty? Well, somebody actually did know this, but it's quantifiable now, okay? So big moves are much harder to fill than little moves, okay? And the takeaway is, it tells us that volume preceding the gap is very important to determine if the gap is going to continue to move in its direction or if the gap is going to revert. It also told us something else. It told us there's a very nice sweet spot right here for 3-day gap fills. Very nice sweet spot right here. Very nice sweet spot. 5 days fills. Now, you don't want to be in more than 5 days. But if you have let's say you have a $300 stock, okay? And the stock gaps down $4.50. That's 1.5%, right? If the volume was lower than the 20-day average before that gap occurred, you've got a 77% chance the price is going to move up $4.50 over the next 3 days, and an 82% chance that it's going to move up over the next 5 days. Now, I want you to think about something right now. That program that we have that's called Stealth Surge, where we buy small pullbacks. What's our win rate on that program, Matt?
On A-line?
No. Stealth Surge?
Stealth Surge, sorry. Yeah.
I'm not putting it in here, Sylvia, for the 4th time. It's not making its way here. I have a place for this. Sorry? Say again?
80%.
Mazel tov. So you're saying the program that buys gentle pullbacks that we've been trading for the last how many years?
Since 2023.
How many trades do we have in there?
132.
80% win rate. Wouldn't you say, Matt, that it's very similar to this right here?
I would.
Folks, so let me put this in English. If you have a stock and the stock now, what if, Raleigh, what if we took this study and we added 2 more conditions to it? And I haven't done this yet, but I'm going to. What if we make one condition that the stock has to be in a very strong trend like this? And the other condition would be that the price before the gap, the last several days before the gap, price is above the 8-day EMA.
Mm-hmm.
You think that would what do you think that would do to the study?
I think once again, if you put those two things together, it's just going to improve the accuracy.
It's going to probably put it to about 85%.
Yep, I would agree.
So I just gave you guys, now, before we got here today, I promised that I was going to give you a real big edge. And I was going to teach you something that you've never seen before. Have you guys ever seen anyone show you this before? No, you haven't. Did you guys know that low volume leading into a gap is really important versus high volume leading into a gap? Hefe, this is a time for me to ask questions, not a time for you to ask questions. Okay. Did you guys know that if a gap is between 2.5% and 4% over the course of 3 days, it'll only fill 50% of the time. But if the gap is 0.75 to 1.5, it'll fill 77% of the time. Did you guys know that? Now, let's say you have a stock that's moving higher and it opens at 1.5% lower and it's in an uptrend. And the day before that, the volume was low. Bingo. Was this beneficial to you guys? Was this beneficial to you guys? Okay. All right. Now, I am going to do something very, very cool for you right now. Do we have any questions? Now is a good time for questions. Do we have any questions?
Yeah. So, Roger, you picked off many of them that were there, but some of the ones that I wrote down was this. Roger, does this also apply to indexes or just to individual stocks?
Individual stocks.
Okay.
Does not apply to indexes.
All right. And then the other question that came up is that, once again, it gets back to the definition of a gap. You're talking about the gap is from the previous day's close to the next day's open. That's the gap that we're measuring. Okay.
That's right. Now, this is not based on my opinions. This is based on 65,500 tests from 2021 to 2024 on 99 S&P 500 stocks. So if you want to argue with math, God bless. Don't get me involved. Crocs, let's take a look at Crocs. I don't see any gaps in Crocs, but okay. But you see how it went from here to here and it stayed, it didn't go. So yes, I thought you meant reversion. Yeah. Gaps, see it moved from 92 all the way to 98. That's like 5%. And what did it have on the day of the gap? High volume. The gap stayed.
Volume. Yep.
So, do you guys want to know if the gap is going to come back or not? How big is the gap? How much volume did you have going into the gap? These things will give you a real mathematical number of what you can expect. Like, for example, look. So just to kind of give you a real practical, let's use this as an example, okay? Let's just use this as an example. So here. Okay. 3 days, okay? The gap was over 4%, 38% that it's going to get filled. And what if it has high volume? 29% gap fill. Has this been filling in the gap? No. And again, Oxy, let's look at Oxy. There you go. Nice, big fat gap. Volume, definitely 2.5 times. There, you have less than 25% chance. And by the way, what have I been telling you all this time? Volume, volume, Volume. It's very, very, very important. Volume.
Yeah, it's kind of like digging a deep hole with gusto.
Yes. Yes. So, did you guys know any of this? And how useful is this information for finding trades for yourself and doing gap trades? I would say this is, I mean, you could make a living just with what I taught you today. I'm not kidding. If you're a crafty beast. All right, let me show you stocks.
There was one other quick question,
Yes. Oh,
Roger.
yeah. Please.
That came up, and it was one. So out of all that 65,000 things that you modeled, the question was, hey, just roughly, how many were gap ups and gap downs? Does it balance out pretty
I have
evenly?
that number. Hold on. I have that number. Hold on. I have that number. 57.6% were up, and 40, it was basically, it was equal.
Almost
Almost
equal.
equal. Almost equal.
And really everything that you shared with us today, it applies equally whether it's a gap up or a gap down. There's no bias on this towards up gaps, for example.
Which is important because the
It
market has an
is.
upwards bias.
Yep.
So gaps like this with high volume, you've got about 30% chance that they will come back down.
Hmm.
Gaps with low volume and small gaps have a very high percentage they'll
Much
come
higher
back.
percent chance that they're going to fill, right?
And what I'm going to do next is I'm going to add a trend filter to this study and an 8-day EMA to say, hey, what if? Now let's look at all the bullish, basically gaps down on a strong chart. And let's look at all the gaps down on a really, really weak chart. And I could do that very easily without curve fitting.
Hmm.
And see, Steely says taking priceless notes. Thank you. You're welcome.
Hmm.
Folks, if you don't understand how powerful this is, then you're completely missing the boat. This is about as close to the Holy Grail as you're going to get. Okay? Imagine you sitting here and looking at 65,000 trades. That's what I'm giving you. It's like having 65,000 gaps analyzed. That's what I did for you guys. To 30 something thousand to the long side, and 30 something thousand to the short side.
Hmm.
And I think if you were to ask any guru right now, they would say, "Hey, this is really cool. This is really cool." I did not see. I always knew 100%. I never had it quantified. But I've told you guys, don't think big moves are the best. Little moves are the best.
Right.
Little moves. And I've explained it, and I made a quantum indicator based on it. So this wasn't new for me. But having it quantified, it was new. And adding the volume, to me, the volume was huge.
Hmm.
Because you're not measuring volume in real time. You're going based on the volume of the day that the gap was created. So you're just looking at the average volume, like right here. So if you have this gap on a volume day like this, there's a much lower odds that the gap will remain versus non-remain. Same thing. If you have low volume and the gap is very small, it's almost a goner, almost a guaranteed goner. So imagine you're trading a stock like J&J, and you're just you look at it every morning when it's in an uptrend like this, and you're looking for a gap down of 1% and the volume is low. That's money right there, folks.
Right.
I don't know how else to tell you. That's free money right there. Right? That's money right there. That's just straight up money right there.
This is awesome, Roger. Because I
Yeah.
know, as you know, as retail investors, we're confronted with gaps all the time.
Yes.
The question is what
Yes.
to do. Do you just stay away from them and look for something else? And you're going like, well, it really depends. But they do happen and they do occur, and here's how to analyze them.
So
Yeah.
let me just take it one step. Let me just kind of take it ahead. Now, let's say you're trading and your favorite stock has a big ass gap up on high volume. Hey, the odds are it's going to continue, or at least it's going to stay there. Oh, we have a gap down. It's a downtrending stock, and it's a gap down, but it's only, and it gaps up, and it's only going up 1.75%, and volume is low. That's a gap fill right there. See that? So using this information and using these thresholds with the volume thresholds I gave you, that's about as good. I mean, you can create a really nice trading system based on that.
Mm-hmm.
I mean, look at this. Look at this. Think about this for a second. Look, you've got, I get very excited about this.
Yes, you do.
But I mean, I have a good reason to get very
Yeah,
excited
you
about
do.
this.
Yep.
So, I mean, think about this. Look at look at the differences between these numbers. 4%, 38%, 1.5, 77, and a 5-day 82%. You know how I always tell you buy options if you're day trading for 4 to 8 days out? 5-day 82%. That's a system right here. Don, why else do you think I went in on it today? I wanted to show you a real example of what we're doing. And again, it's not guaranteed, but when you add a move, a little down move like this, and it wasn't a gap too on Johnson Johnson, and you add the volume, it can really, really move. Like we had a really nice down move on Johnson Johnson this morning, but look at today's volume. We're still below the average, and we're already moving up. And we're up on the trade like, I don't know, like 50, 60 cents or something silly. But, or like actually, I think we're up $1.50 on the trade. Sorry, we're up about $1.50 on the trade. My mistake. My mistake. How much are you guys up on the Johnson Johnson trade? Let me know, just out of curiosity. But we're up. But my point is, you could make a system. You can just find in the morning. You could find stocks at night that are doing this. Thanks, Sandy. Yeah, you could find stock $1.50. Yeah, you could find stocks. You could find stocks that are doing this and look for down gaps of 1.5% or them coming down to the 8-day EMA. Ooh, baby. See my point? This is really good information. This is really good information. All right. So let me do something. I want to give you my watch list right now, and then I want to give you a presentation on gaps. And the material, this class, between the start and the end, is going to be inside the Gap to Green members area. All right. So, folks, pay attention. This is only going to take about 20 minutes. It's really important. And
so, Roger, real quickly, are you going to give your stock watch list and then move into this, or?
yes. Sorry,
Okay.
I
I didn't know if you were going to list it in the chat or
no,
talk it
no, no,
through.
no. I'll just give it to you. I have time. I've got
Oh,
time.
okay.
I just didn't know what time it was. I've got time. Okay.
Yeah,
Oracle to the short side. Very, very, very nice. Very, very nice. Oracle, KLAR. By the way, speaking of gaps, see how we had a gap here?
on big volume. Yep.
Let's see, 12, was it 2% or 12% of its price. Big gap on volume. Which way is it moving?
Yep. Continuation.
I'm telling you, there's something to this. How about team? Not a gap, but nice short. Very, very nice. These are shorts. Adobe, kind of choppy right now, but looks like it wants to come back down, start to come back down. PayX, very nice. A, below the 200-day. PayAC, don't confuse this with PayX. This is PayC. They're very, they're very similar. And NSP. Look at that. I'm giving you guys pure gold today, okay? Let's move to the upside. FedEx. Okay, like this stock. Like this is the kind of stock I would be looking for gaps on. And look at this gap. It's an up gap, but look at volume. What happens? Just showing you. GLW. Nice stock. Applied Materials. Very nice stock. Micron, also another chip stock. You might have seen this once or twice the last few days. We took profit on it today in the pit, Raleigh. COHR. I know Richie took profit on this one this morning. CSX, CNP, MNST, TR, JCI, ADI, CN, HWM, and GEV. That's my list. That's my list. Now, I'm going to give you a cool class. This class is only going to take about half an hour. And while I'm teaching this class, I want you guys to be thinking, about what we just covered. Now, this class and the materials, let me just let them know to put this, to carve this out. 1 second.
Yeah. And while you're doing that, I want to remind everybody that's with us here on YouTube, we're about to stop the YouTube stream. YouTube doesn't allow us to do promotional events on YouTube, so we have to stop that. Now, if you'd like to be with us for a continuation of this discussion, please come and join us in the Zoom room. And I'll give you a few seconds to do that, but come join us in the Zoom room for the rest of this presentation.